Welcome back to UK Property Info, and today I want to take you on a journey through one of the most significant transformations in London's property history. What I'm about to share with you is the result of extensive research, countless hours analysing publicly available data, and conversations with industry professionals who are witnessing these changes unfold in real time. The London rental market is experiencing a fundamental restructuring that affects millions of people, and I believe everyone deserves to understand the forces at work. So grab a cup of tea, settle in, and let me walk you through what is really happening beneath the surface of London's housing market. Let me start with something that happened to someone close to me earlier this year. A friend of mine was searching for a rental property in South London. She had a reasonable budget, clear requirements, and plenty of patience. After weeks of searching, she finally found what seemed like the perfect two-bedroom flat. She arranged viewings, submitted her application promptly, and waited with cautious optimism. Then something strange happened. The property simply vanished from every major listing platform. It was not marked as let. It was not sold. It just disappeared without explanation. When she contacted the letting agent, they were evasive, offering no clear answer about what had happened to the property. At first, I thought this was just bad luck, an unusual circumstance that occasionally happens in a competitive market. But when I started asking around, I discovered that similar stories were emerging across the capital. Properties were disappearing from the rental market in ways that did not fit normal patterns of lettings or sales. This observation prompted me to undertake a systematic examination of London's rental market data. What I discovered over the following weeks fundamentally changed my understanding of what is happening in the capital's housing sector. The mainstream narrative about London's rental market focuses on gradual adjustments, normal cycles, and predictable trends. But the data tells a much more complex and concerning story. Let me share what the numbers actually reveal when you take the time to analyse them properly. According to widely reported figures, London rental yields have declined by approximately 12% this year. That sounds significant but manageable, the kind of adjustment markets experience periodically. However, when I dug deeper into the publicly available data from various sources, a different picture emerged. The actual changes in certain London boroughs have been far more dramatic than headline figures suggest. Some areas have experienced value adjustments of 30% or more since the beginning of the year. Tower Hamlets, Hackney, Lambeth, Southwark. These boroughs have all seen substantial shifts in their rental property markets. Even traditionally stable areas like Westminster and Kensington have not been immune to significant changes. The variations between different neighbourhoods and property types are remarkable. What struck me most was not just the scale of these changes, but their timing and pattern. Rather than the gradual adjustments you would expect in a naturally evolving market, some of these changes appeared to happen in concentrated bursts. Values would remain relatively stable for weeks, then shift dramatically in very short periods. This pattern raised important questions about what forces were driving these movements. To understand what is happening, we need to step back and examine the broader context of London's rental market over the past decade. The private rental sector in London has undergone a remarkable transformation since 2010. Individual landlords, often called amateur or accidental landlords, traditionally owned the majority of rental properties in the capital. These were teachers, nurses, small business owners, and retirees who had invested their savings in one or two properties to generate income. They formed the backbone of London's rental supply, providing housing for millions of tenants across the city. But this landscape has been changing dramatically, and the pace of that change has accelerated significantly in recent years. Several factors have combined to make small-scale landlordism increasingly challenging in London. Changes to mortgage interest tax relief, which began in 2017 and were fully implemented by 2020, fundamentally altered the economics of property investment for individual landlords. Under the old system, landlords could deduct their mortgage interest payments from their rental income before calculating tax. The new system treats rental income as income first, then provides a basic rate tax credit for mortgage interest. For higher rate taxpayers, this change was devastating to their profit margins. Many landlords found themselves paying tax on income they never actually received because their mortgage payments exceeded their net profit. A landlord earning £50,000 from rental income but paying £40,000 in mortgage interest would previously have been taxed on £10,000 of profit. Under the new system, they might face tax liability, calculated as though they had earned £50,000, with only a basic rate credit for their interest payments. For many, this turned profitable investments into loss-making ventures overnight. The regulatory environment has also become increasingly complex. Landlords now face a patchwork of requirements including energy efficiency standards, electrical safety certificates, gas safety checks, deposit protection rules, right to rent checks, and numerous other compliance obligations. Each individual requirement may be reasonable and justified, but the cumulative burden of managing all these obligations has become overwhelming for many small-scale landlords who manage properties alongside their regular careers. A landlord with a demanding full-time job who owns a single rental property can find themselves spending significant time each month simply maintaining regulatory compliance. The time investment required often exceeds what many anticipated when they first purchased their investment properties. Then came the pandemic, which disrupted rental markets in unprecedented ways. During lockdowns, London experienced a remarkable exodus, as tenants who could work remotely chose to leave the capital for more space in suburban or rural areas. Rental values in central London fell significantly during this period, with some areas experiencing declines of 20% or more. Landlords faced extended void periods, rent reductions, and the challenge of marketing properties during a time of profound uncertainty. Many landlords who had been considering exiting the market accelerated their plans during this period. The combination of reduced rental income, ongoing mortgage obligations, and uncertainty about the future proved too much for thousands of property investors. As we emerged from the pandemic, the rental market experienced a dramatic reversal. Tenants flooded back to London as offices reopened and city life resumed. But the supply of rental properties had contracted significantly during the intervening years. Thousands of landlords had sold their properties, often to owner-occupiers rather than other investors. The result was a severe supply shortage that pushed rents to record levels. According to various indices, London rents increased by double-digit percentages in 2022 and 2023, far outpacing inflation and wage growth. Tenants found themselves competing for a shrinking pool of properties, facing bidding wars and offering months of rent in advance simply to secure accommodation. The human cost of this shortage has been immense, with families forced to relocate, commutes extending dramatically, and many people spending unsustainable proportions of their income on housing. Against this backdrop, we have seen the emergence of a new type of landlord in the London market. Institutional investors, professional property companies, and build-to-rent developers have been expanding their presence in the capital's rental sector at an unprecedented pace. These are not individuals with one or two properties, but sophisticated corporate entities with portfolios spanning thousands of units. They bring significant advantages to property acquisition and management. They have access to cheaper financing through institutional capital markets. They can spread compliance costs across large portfolios, making per-unit regulatory expenses far more manageable. They employ professional property managers, lawyers, and compliance specialists who can navigate complex regulations efficiently. They can make rapid purchasing decisions when opportunities arise, moving faster than individual buyers who need mortgage approvals and personal deliberation time. The growth of institutional ownership in London's rental market represents one of the most significant structural changes in the capital's housing history. Properties that were once owned by individuals are increasingly passing into corporate portfolios. This transition has profound implications for tenants, for communities, and for the nature of housing in London. Institutional landlords operate differently from individual property owners. Their primary obligation is to shareholders and investors seeking returns, not to local communities or long-term tenant relationships. They use sophisticated revenue management systems to optimize rental income. Employing algorithms and data analytics to set and adjust prices. They standardize tenant experiences across their portfolios, which can bring benefits in terms of consistency, but may reduce the flexibility and personal relationships that characterize traditional landlord-tenant interactions. Some observers welcome institutional investment in housing, arguing that professional management brings higher standards and more reliable service for tenants. Purpose-built rental developments often include amenities that traditional buy-to-let properties lack. Concierge services, gyms, communal spaces, and professional on-site management can enhance the living experience. Corporate landlords may be more responsive to maintenance requests because they have dedicated staff and systems to handle them. They are less likely to sell the property unexpectedly because they are operating with long-term investment horizons. These are genuine benefits that many tenants appreciate and value. However, other aspects of institutional ownership raise significant concerns. Corporate landlords are typically less willing to negotiate on rent or offer flexibility during difficult periods for tenants. They are more likely to enforce lease terms strictly and to pursue eviction when payments are late. They view housing primarily as an asset class to be optimized rather than as homes that shape communities and lives. The concentration of rental housing in fewer hands also raises questions about market power and competition. When a significant portion of rental properties in an area are controlled by a single company or a small number of companies, the dynamics of the rental market shift. Landlords in competitive markets must offer attractive terms to secure tenants because renters have alternatives. But when options are limited, the balance of power shifts towards property owners. Tenants may find they have little choice but to accept the terms offered, even if those terms are unfavourable. Rents can be maintained at higher levels because there is insufficient supply of competing properties to exert downward pressure. This concentration of market power is particularly concerning in a housing market where supply constraints are severe and where tenants have limited alternatives. The policy environment has played a significant role in shaping these market dynamics. Local authorities across London have introduced various initiatives aimed at regulating the rental sector, from licensing schemes to enhanced enforcement of housing standards. These policies are typically presented as measures to protect tenants and improve housing quality. Many of them have achieved genuine improvements in the condition of rental properties and the treatment of tenants. However, the compliance costs associated with these regulations have not been evenly distributed. Large institutional landlords can absorb these costs relatively easily because they can spread them across vast portfolios and employ specialist staff to manage compliance. Individual landlords face a very different calculation. For someone with a single rental property, the fixed cost of licensing, inspections, certifications, and administrative requirements represent a much larger proportion of their rental income. The economics simply do not work for many small-scale landlords, particularly those whose properties generate modest returns. This differential impact may not have been the primary intention of these policies, but it has been their practical effect. Regulations that impose fixed costs regardless of portfolio size naturally advantage larger operators over smaller ones. Each new requirement, however sensible in isolation, contributes to an environment where individual property ownership becomes less viable. The cumulative effect has been to accelerate the transition from individual to institutional ownership in London's rental market. Whether this outcome serves the interests of tenants in the long run is a question that deserves more attention than it typically receives. In the short term, reducing the number of poor-quality landlords and improving housing standards benefits tenants directly. But in the longer term, the concentration of the market in fewer hands may reduce competition and tenant bargaining power in ways that offset these benefits. The financial dynamics of the current market deserve careful examination as well. Interest rates have risen dramatically since late 2021, increasing the cost of mortgage finance for all property investors. Landlords with variable rate mortgages or those whose fixed rate terms have expired are facing significantly higher monthly payments. For many, these increased costs cannot be fully passed on to tenants because affordability constraints limit how much renters can pay. The squeeze between higher financing costs and capped rental growth has made many properties unprofitable to hold. This pressure has been particularly acute for landlords who purchased properties during the low interest rate era of the 2010s. They may have calculated their investment returns based on assumptions about financing costs that no longer apply. Properties that were profitable with mortgage rates of 2 or 3% can become loss-making when rates double or triple. The rational response for many landlords in this situation is to sell, crystallising whatever capital gains remain rather than continuing to subsidise tenant accommodation from their own resources. When landlords sell, the question becomes who is buying. In many cases, the answer is owner-occupiers, who are taking advantage of prices that have moderated from their peaks. First-time buyers and growing families who were previously priced out of home ownership are purchasing properties that were formerly rented out. This transition from rental to owner-occupation is not inherently problematic from a housing perspective, since the same number of households are accommodated either way. However, it does reduce the stock of rental housing available for those who cannot or do not wish to purchase. In other cases, properties sold by individual landlords are being purchased by institutional investors. These corporate buyers are often able to move more quickly and offer cash purchases that are more attractive to sellers than conditional offers from individual buyers who need mortgage approval. The relative financial strength of institutional investors allows them to accumulate properties during periods of market stress when individuals are selling under pressure. Understanding the motivations and strategies of these institutional investors is crucial to grasping the current transformation of London's rental market. These are not charities or public interest organisations. They are commercial enterprises that exist to generate returns for their shareholders and investors. Their decisions about which properties to buy, what rents to charge, and how to manage their portfolios are driven by financial considerations. This does not make them malicious, but it does mean that tenant welfare and community impact are secondary considerations at best. The investment theses of major institutional landlords typically involve acquiring properties at favourable prices, professionalising management to improve operational efficiency, and benefiting from rental growth over time. They view London's structural housing shortage as a positive factor because constrained supply supports rental values. Their investment horizon often spans decades, allowing them to take a long-term view that individual landlords with shorter planning periods cannot match. The consolidation of London's rental market raises important questions about the future of housing in the capital. What happens to communities when the relationship between landlord and tenant becomes purely commercial, mediated by call centres and management companies rather than personal interaction? How do renters build stake in their neighbourhoods when their homes are components of investment portfolios managed from distant offices? What recourse do tenants have when a small number of large companies control a significant portion of available housing? These are questions that policymakers, housing advocates, and citizens need to engage with seriously. The decisions made in the coming years about how to regulate institutional landlords, protect tenants, and support diverse housing ownership will shape London's communities for generations to come. For those currently navigating London's rental market, whether as tenants seeking homes or as investors evaluating opportunities, understanding these dynamics is essential. The market that exists today is fundamentally different from the one that existed a decade ago, and it continues to evolve rapidly. Tenants should be aware that their rights and options may differ significantly depending on whether they rent from an individual landlord or a corporate provider. They should understand the terms of their tenancy agreements carefully and know what protections are available to them under current law. Those considering property investment should carefully evaluate whether the current market conditions and regulatory environment suit their circumstances and objectives. The returns available to individual landlords have compressed significantly, and the operational requirements have increased. For some investors, property may still make sense, but the calculations are more challenging than they were in previous years. Looking ahead, several factors will shape the evolution of London's rental market. Interest rates will eventually stabilise, though whether at current levels or higher or lower remains uncertain. New supply from build-to-rent developments and converted office buildings will add to the rental stock, though likely not quickly enough to address the current shortage fully. Regulatory changes, including potential rent controls and enhanced tenant protections, will affect the viability and attractiveness of rental property investment. Political considerations will play a significant role as well. Housing affordability is a major concern for voters across London, and elected officials face pressure to take action. The policies they choose will shape incentives for landlords, developers, and investors, determining whether the market continues to consolidate or whether there is space for diverse ownership structures. My purpose in sharing this analysis is not to promote any particular political agenda or to suggest that there are easy solutions to complex housing challenges. The reality of London's rental market is shaped by countless individual decisions, macroeconomic forces, historical policies, and fundamental constraints on land and construction. What I hope to offer is clarity about what is actually happening and why, cutting through simplified narratives that obscure more than they reveal. The transformation of London's rental market from one dominated by individual landlords to one increasingly controlled by institutional investors is a significant change with real consequences for millions of people. Whether this change is ultimately positive or negative will depend on many factors, including how institutions behave, how effectively tenants are protected, and how the market evolves over time. For those who want to engage more deeply with these issues, I encourage you to explore the publicly available data on property ownership, rental trends, and market dynamics. The Land Registry publishes transaction data that can reveal patterns of ownership change. Housing associations and research organisations produce regular reports on affordability and market conditions. Local council planning documents show what development is in the pipeline for different areas. Armed with information, we can all make better decisions about our own housing situations and contribute more effectively to discussions about housing policy. At UK Property Info, we remain committed to providing thorough, thoughtful analysis of the UK property market. We believe that understanding complex issues is the first step toward addressing them effectively. Whether you are a tenant trying to find affordable accommodation, a landlord considering your options, or simply a citizen concerned about housing in your community, we hope our coverage helps you navigate these challenging times. Thank you for joining me for this in-depth analysis of London's rental market transformation. I know it has been a substantial amount of information to take in, but I believe these issues deserve the attention and detail I have tried to provide. If you found this valuable, please subscribe to UK Property Info for more analysis and updates on the UK property market. Share this with friends and family who are affected by housing issues in London and beyond. Leave your thoughts and experiences in the comments, because your perspectives help build a fuller picture of what is happening on the ground. In future episodes, we will continue to explore the forces shaping housing in the UK, from new regulatory developments to emerging market trends. The housing landscape is changing rapidly, and staying informed is more important than ever. Until next time, this is UK Property Info, helping you understand the property market one analysis at a time.